This is MacroVoices with hedge fund manager Erik Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Erik Townsend and Patrick Ceresna.
MacroVoices episode 301 was recorded on December 9th, 2021. I'm Erik Townsend. This episode is brought to you by Abax Technologies, pioneering the design of smarter markets that better serve the needs of both market participants and society as a whole, and by Escrow.com, the world's most secure online payment system from a counterparty risk perspective because the funds sit in escrow. MI2 Partners founder Julian Brigden returns as this week's feature interview guest. Julian disagrees with the transitory inflation argument posed by David Rosenberg last week and will explain why in the degree of detail Julian is known for. He's also known for his graphs and charts, so don't miss this week's slide deck. Then be sure to stay tuned for our postgame segment when Patrick's chart deck is titled Correction or Crash, Part 2.
And I'm Patrick Ceresna. Erik, let's jump straight to that S&P 500. We were in a correction last week. Seems to be at least some sort of a short-term bottom in there, and we're trading right back near the 52-week high. What's your take on how this is all developed?
Well, I think it's pretty much just what we predicted last week, which is Omicron was overstated in terms of its risk to the economy. It is a big deal. It's going to be much more transmissible than any of the other strains, but it looks like it's going to have lesser symptoms. There's even an argument that it could crowd out the Delta strain and be a blessing in disguise. So it seems like Omicron panic has retraced almost fully in the equity market, although certainly not yet in the crude oil market. But I think now, Patrick, we have to look to Fed policy and consider, I'm absolutely convinced that the Fed will rescue the market next time the market needs to be rescued. But after they just pivoted pretty darn firmly to this very, very hawkish stance that they're going to aggressively taper very quickly, the Fed can't pivot again until the market gives them a reason to. And they're certainly going to give us policy that might very well lead the market to give them a reason to. So let's see what happens in terms of stimulus to come and so forth. But I think now we need to look at what Fed policy is going to mean for the market and whether or not this rally can continue. Because I certainly think it has been central bank largesse that has funded the rally to this point. If that's going to be at least temporarily cut off, well, that means maybe the rally should be cut off too.
All right. Well, let's move on to the dollar index. Obviously, even arguably for the last 6 months since June, the dollar has been in a primary uptrend. And while the trend has paused, we haven't really seen the dollar back off, at least on the index, too far off of the 97 high it put in. Do you think the dollar uptrend is still intact?
Well, we're consolidating here off of that 97 high between 95.5 and 97, and until that consolidation plays out and we see what the next move is, we don't know. I think certainly if we do get a move higher from here, in other words, if this consolidation pattern breaks to a new upside breakout above 97, it's kind of a new game at that point because I think that would pretty clearly say that we're out of the trading range that has existed for the last several years, and we really are probably headed back toward 104 at that point, just in terms of what the technical indication would be if we had a sustained breakout well above 97. On the other hand, we've had some very well-spoken dollar bears on this program in recent weeks. If they're going to be proven right, they need to be proven right pretty soon here, because if it goes too much further to the upside, it's going to be hard for that argument to stay right. So let's see what happens in coming weeks.
All right, well, let's talk crude oil because there was no shortage of volatility. Obviously, we had that almost outright liquidity event, I'd call it even a crash on the downside. And since then, we seem to have put in some sort of a tradable low. We're almost $10 off the lowest it printed. But do you think that that's a tradable bottom now, or do you think there's still risk in the crude oil markets?
Well, there's definitely still volatility risk, and I mean a lot of volatility risk in the crude oil market. I think that should be the low unless we get really substantial new bad news. The place where the really substantial new bad news could come, of course, would be on the virus front. Everything I'm reading about Omicron is really telling me that, no, it's not going to be a big problem. In fact, we probably have still got plenty of retracement ahead of us as we realize that panic was misplaced to start with. Now, if that changes and the medical data changes and the facts change, I'll change my opinion, needless to say.
Erik, let's talk about those inventory numbers. How did they come in?
Crude oil drawing down 240,000 barrels, so a drawdown, but a small drawdown. Cushing, Oklahoma, building a nice, big, healthy build of 2.4 million barrels, very much needed there in Cushing, Oklahoma, which was running very close to its minimum operating levels for a while there. Also, big builds on gasoline and distillates. Gasoline, 3.9 million barrels, distillates, 2.7 million barrels. So all of those big builds should have been a bearish signal. Really didn't stop the market from going higher, at least initially, but then today we got more Omicron news. This time it's just confirmation that this strain is many times more transmissible than the Delta strain. And we pretty much already knew that, but it's been confirmed now, and that news took us a little bit lower today. I don't think, unless we get substantial new news, that we're going back down to that low, Patrick, but any amount of volatility is possible here. U.S. production ticked up another 100,000 barrels to 11.7 million barrels. All those experts, Patrick, who told us that there was no possible way that we could ever get back to anything close to previous U.S. production records without that massive amount of cheap, easy junk bond money that financed the last shale boom. Well, gosh, we're headed back in that direction pretty quickly. We're not quite above 12 million barrels yet, but we've come a long way. It was just about 10 million barrels a few months ago. We're up to 11.7.
All right, well, let's touch on gold because while a lot of markets have bounced and started to recover off of that weakness that came a few weeks ago, gold is not one of them. I mean, we're more or less still trading in the same price ranges that we were for the last 2 weeks, and there doesn't seem to be any sign of any buyers right now. Is this a sign of further weakness to come in your mind, or is this just more of the same trade range in your mind?
Well, I fear that it may be a sign of more to come to the downside. And I want to ask you, as the technician in the house, normally when you see a breakout, as we clearly saw on that inflation print, gold broke out to a new cycle high, and then it fully retraced. Well, that full retracement is very common in technical analysis. It goes down and tests what was previously a resistance level as a support level. We've come all the way down to that, maybe a little lower than that, and we normally would look for either an upside or a downside resolution. So far, it's just traded sideways. So I'm assuming, Patrick, from a technician standpoint, we really can't call this until we see either a breakout upside or a breakdown downside. From here, I don't know what's coming next, but one thing is clear is all of the predictions that we made that should have led to higher gold prices already came true, and we haven't got the higher gold prices. So I think we have to question whether or not gold is still serving the same function as a hedge against currency debasement as it used to.
Well, I have to agree with you, and I have a chart for our post-game chat. So let's actually wait till we have the chart up and we can talk about some of these different levels. But it was certainly disappointing the way the magnitude of the pullback and the lack of responsive buying right now. It certainly is making this sort of a dead asset for now. Let's move on to that 10-year Treasury yield, which bounced back north of 150 on the yield on the 10-year, but really no big real action here in the bond markets and the yields in the last couple of weeks. Has anything changed in your opinion from the last couple of weeks?
I've been really fascinated to hear our expert guest's view on this. David Rosenberg last week, obviously having a very strong view. Julian Brigden's going to have a very different view this week. I'm in the listening seat on the whole bond market situation. The way I feel about this is we're probably pretty darn close to the end of the 35 or 37, 38, however many years it is, bull market in bonds. But that doesn't mean it's time to expect a new secular bear market in bonds. We could easily go a decade down here and just stay here. So I'm listening to what the experts say. Let's see what we find out from Julian Brigden in today's interview.
Well, this week's feature interview guest is MI2 Partners founder Julian Brigden. Erik, why did we get Julian back on the show this week?
Julian is a brilliant macro thinker and very well known for his chart decks, and we wanted to get Julian back on to continue this inflation-deflation debate that we've had. We're trying to get more of our expert guests kind of alternating views and getting them to comment on the views that have already been expressed by prior guests. So we're going to keep that tradition going in this interview.
Well, Erik's interview with Julian Brigden is coming up as MacroVoices continues right after this message from our sponsor.
This episode of MacroVoices was brought to you by Abex, a fintech company traded under ticker symbol ABXXF on the OTCQX in the United States and ABXX on the Equitas Neo in Canada. Abex was founded on the principle of creating market-based solutions to solve the world's most challenging problems. Two of these issues in particular, the energy transition and climate change, are creating once-in-a-generation opportunities for investors. Abex is leveraging proprietary Web 3.0 technologies to digitize and accelerate the velocity and security of commodity trading markets, beginning with liquefied natural gas and carbon. Investors seeking exposure to the fintech applications powering this new era of the ESG economy can visit www.abex.tech or www.abex.exchange, or check out ABXX on the Equitas Neo or ABXXF on the OTCQX exchanges.
And now, with this week's special guest, here's hedge fund manager Erik Townsend.
Joining me now is MI2 Partners founder Julian Brigden. Julian prepared a terrific slide deck for today's interview. Registered users will find the download link in your Research Roundup email. If you don't have a Research Roundup email, it means you're not yet registered at macrovoices.com. Just go to our homepage, macrovoices.com, click the red button that says Looking for the Downloads. Julian, it's great to have you back on the show. It's been way too long. The inflation-deflation debate rages on. Just last week, I had David Rosenberg on telling us that the 3 Ds, those being debt, demographics, and disruptive technology, assure a disinflationary backdrop for years to come, and that this inflation will be transitory. What say you? And feel free to reference your charts as we get into it.
Well, here's the interesting thing. I'm not going to answer that myself. I'm going to lean on the world's oldest central bank, the Bank of England. And they wrote a piece which we picked up on and we discussed with our clients the other week, probably other month. And we said the title of the piece was "It's Always Transitory, a 700-year history." Because I think there's a real temptation for us to get lost in a very short-term perspective. And by short-term, I mean, 20, 30 years, right? That's our kind of our frame of reference. I mean, even if you're an old git like me, right, who's been in markets, for 30 odd years, right? I mean, it's very easy to just get myopically focused on those last 30 years and lose the longer frame of reference. And what the Bank of England discovered was that basically when they look at the risk-free asset and they look at returns and inflation, that basically since the mid-1460s, we've been in a disinflationary world, David. So I like to kind of use that word as opposed to deflation. And, the drivers are pretty consistent, right? I mean, productivity, demographics, et cetera, And I think there's always this tendency to get very, very excited about developments, that are sort of today, right? To think that the technology we have today is just so utterly transformative. And, I was reading this piece by Barry Ritholtz, who's the sort of equity guy, and he's very, very good. And he wrote this thing and said sort of, it's all really changed since the mid-80s. And I was like, really? If you actually look at productivity since the mid-80s, it's actually not the case, right? Actually, it's been lower than it was in the 60s and the 70s. And also, we shouldn't forget, there were quite transformative events historically. I mean, even in a relatively short period of history, I mean, penicillin, the aeroplane, right? The internal combustion engine, the light bulb, right? I mean, all these things have been bloody transformative, right? So just to assume that Salesforce or cloud computing or all these things are just so much greater, is that really right? So what the Bank of England did was that they look at all these trends and they say, basically, even though we've been in this disinflationary period since the mid-1400s, there have actually been 8 periods, and this would be the 9th, where we've had extended what they call real rate depressions. So incredibly low levels of real rates. Now, they come up with some reasons as for that, but what's interesting is what causes those to end. And the point is, what causes them to end is essentially 2 things typically. Firstly, some sort of geopolitical shock, And then secondly, and this is quite remarkable, particularly some sort of pandemic, some sort of big shock. And you can understand why. I mean, you basically rejig the world. Particularly after a pandemic, you actually reset expectations of workers. You've obviously, certainly in cases, things like the Black Death, right? You've wiped a lot of your workers out, right? So, wages tend to rise. But there's all these sorts of factors that are remarkably consistent over this hundreds of year period. And I think we tick that box. Now, ultimately, even these bouts of inflation prove to be transitory when we go back to that long-term disinflationary trend. So I think the disinflationists are ultimately going to be right. But let's say this bout is typical, last 7 years, right? And we're 2 years into it, maybe. Do you really want to be long fixed income for the next 5 years? Because you're going to get hosed. I mean, that's a life, that's a career, right?
So you're saying that the disinflationists have it right. We are going back to disinflation, but we could have something like the 1970s happen between now and then.
Yeah, it's not. I mean, I think personally, I think the analogy right here, right now is the late 60s, but I can construct the 70s.
Let's dive into page 2 of your slide deck and take a look at the core PCE and final demand charts that you've got. What's going on here?
So, I mean, just these are sort of some short-term plays, right? We've been, as you alluded to at the beginning of the interview, we've been in the inflation camp for a long, long time. Not just in this iteration, Erik, but we really started talking about it when Trump came in, right? And he did that unnecessary pro-cyclical stimulus that you got. And I think absent COVID, that would have been the low in bond yields back in 2016. But what this is talking about is just how much more pressure is in the system, right? Now, I think it's important that finally the Fed is beginning to wake up to this, because I actually think we're at a very, very pivotal point. So we kind of got lucky in timing this interview. But this is just an illustration of what could be still in the pipeline, right? So to say it's all about to peak, this is the peak, we're at the highs, I'm not sure that's the case. In fact, it's my bet that we're definitively not. So this is looking at the new final demand PPI that they produce. Conveniently, it's about 2 percentage points lower than the old PPI, but it's actually very good at, because it is a final demand metric, at looking at what happens and feeds through into CPI. And you can see at this point that we have basically the best part of 500 basis point divergence between PPI and core PCE. Now, what happens in that scenario? Well, there's a couple of scenarios. Firstly, maybe those PPI prices just evaporate. Well, if you go and look at the ISMs, that is not happening. Right? I mean, businesses are definitively not seeing significant reduction in input costs, right? Their prices are still feeding through. They're still planning to put through price increases. I mean, Kellogg's, for example, are planning, I think, 20% price increases next year. So if the PPI isn't going to go away, fine. What do? They can eat them. Don't think they're going to do that. I'll go through why I don't think they're going to eat those price increases. And then they pass them through. So if they pass them through, what does it mean for CPI, right? Well, the typical spread, even if we're very generous, like the highs of the spread that we saw in 2017, 2018 was 125 basis points, okay? So let's say that that's what happens, that PPI sits here, CPI just core PCE, plays catch up, then you're looking at core PCE of 7, Erik. I mean, Powell's already told us that what's going on already with core PCE in the 4s is inconsistent with price stability. 7, these numbers are insane, right? And the numbers actually are even worse in Europe because their PPI increases are really off the charts. Now, at some point, I would guess probably in February or March, when we start to get the January or February data, we should start to see some of these numbers start to peak. There are some relatively robust base effects that should they bloody better start to weigh on these headline numbers. But even when those drop away, the core pressures are going to be acute. So, for example, if you look at owner equivalent rent, which we know is about 30% of CPI, our models somewhere, and this is a very conservative one I've taken here, shows the low fours. I've got one that shows 5 and change. It's a little bit more erratic, but it's very good. The Dallas Fed one, and this is probably not a surprise why Kaplan, the Dallas Fed governor, was so hawkish. They had almost 7% by the end of 23. I mean, these are swinging numbers. You are not going to get core inflation down if your rents are increasing at anywhere close to these sorts of levels. And I think the Fed are beginning to realize they're playing a very dangerous game, right? Because we do have rising inflation expectations if you look on slide 4. Whether it's I mean, sure, the short-dated stuff is more elevated than the long-dated stuff, but even the long-dated stuff is starting to push to some pretty heady levels, okay? Some pretty heady levels. You're looking really at 4% for the sort of 3-year and longer stuff. And this is dangerous because the Fed's own work, Erik, suggests that in the late 1960s, and we'll talk about that at the end of the presentation, it may have only taken 2 years for, as they would term it, for inflation expectations to become unanchored. So you're really playing with fire here. And I think it's one of the reasons why the Fed has been pivoting so hard. And we'll come back to what the ultimate reason I think they've done it and the implications for that in a second. But the fundamental problem, I think, that's caused this is we just overcooked it. So if you look at slide 5, one of my clients has done an awful lot of work on this, and they have data I dream of having access to. So they went and looked at 28 countries. They looked at 120 years worth of data for each one. And they looked at the impact of fiscal and monetary stimulus and the feed through into inflation. And what they discovered is if you fire one of the barrels, fiscal or monetary, not really that much of a relationship. When you pull both triggers, though, particularly with a certain degree of ferocity, then the feed through to inflation is nigh on perfect. And they asked us to go and construct a model, which we did. And that's what we call this excess stimulus model in green. And what you can see is it's a very good leading indicator. It leads by about 18 months for inflation. Now, there are some base effects in there, and that's why I've split the graph up. You can see it worked very well in the 70s, worked very well into the mid-2000s. And then you go and look at slide 6. Now, that's now. There's a couple of things to bear in mind, Erik. So the first thing is, look at the size of the stimulus compared to the post-GFC stimulus. It's just utterly disproportionate. And the thing is, it doesn't just happen, right? We've spent all this money. I've got some clients who've got a big muni portfolio, okay? And they tell me that the states are still sitting on money from the handouts that they got, earlier this year. They're still working through how to spend them, right? So there's plenty of money. And by the way, we've got a big fiscal stimulus. We've got an infrastructure stimulus package working through, right? Which come beginning of 23 will start adding about, and this is just the federal bit. Remember, the states tend to chip into these projects when you do infrastructure spending, but for almost the lion's share, right? The federal one's worth like 0.75% of 1% on GDP, right? So these numbers could be big, and this thing is still feeding through. It's like the boa constrictor has swallowed the sheep, right? It doesn't just dissolve overnight, right? This thing could sit in this stomach for ages and get metastasized, right? And that's exactly what's happening. This stimulus is working through the system. Now, the final thing to bear in mind in this chart is this uses detrended CPI. So you really have to think about it as kind of like an incremental model, additive to where CPI is at the time, as opposed to just showing you a level. What it basically tells you is close to 10% core by the end of this coming year and into 23. I mean, these numbers, Erik, are inordinate. We just blew out M2 at almost 30% per annum. Where does that money go? It doesn't just dissipate overnight. It's still growing at like 13%, which, by the way, would be the highest number bar this in the post-war period. I mean, these numbers are ginormous. We just overcooked it. And if you want another example of this, look at slide 7, right? We are trying to push through 34% higher goods demand than prior to COVID. The issue, we'd have bloody supply problems in a normal world. There's too much aggregate demand. Oh, and by this way, this thing that Yellen's telling us, don't worry, right? We'll be all satiated when it comes to physical goods, right? We'll go and spend it on services. Well, good luck with that, love, because demand's already 4% higher there. And if you think you're just going to find the workers who are going to all feed us at McDonald's and every single restaurant, you and I all know, and everyone else listening to this all knows, that that isn't the case, not for the wages that you're trying to pay. What we've done is we have created too much aggregate demand because we thought this was the GFC. We thought this was going to be how we would play out. We had to support aggregate demand. It was kind of the right thing to do, but we just did too much. This is not a stagflationary environment, right? Stagflation is when really the definition is when prices destroy aggregate demand. In the old definition, when there's too much money chasing too few goods, that is by definition inflationary. Right? Just look at the demand for labor, Erik, right? And this is the one that's really causing the Fed conniptions on slide 8, right? So the Fed had assumed, maybe correctly, that the participation rate would recover, right? It dropped about 2 points during COVID. From I think like 63 to 61. And they'd assume that people would come back, right? Well, was it a realistic assumption? I don't know. Maybe they didn't see that survey that 4% of Americans have decided they've retired because they've made so much money in crypto, right? God help us. But the point is they assumed that it was coming back. And so if you assume that the participation rate was coming back, you could run this thing a little hot. Well, unemployment, actually, if you tend to look at this chart, once it gets going, it's a pretty linear relationship, right? If you look at the relationship in the fall of unemployment between sort of 2010 and 2019, it's pretty much a 45-degree line, right? One job begets another, begets another, begets another, begets another, begets another, okay? Look at what we're doing now, right? A, they have just miscalculate how quickly this thing is falling, and B, they've just miscalculated even if everyone came back into the labor force, even if those 4% of crypto retirees decided that they really wanted a part-time job working at McDonald's, even if they all came back into the labor force, there is so much aggregate demand out there that the level of jobs that it supports would drive unemployment to 1%. Insanity. Because there's no way that 1% isn't way below full employment. What I'm told is this current crowd within the FOMC believe it's like 3.8 is full employment. Now, that's quite a big drop from the prior level. It's about 1%. So it's quite a woke, in this sort of wokey world that we live in, right? That's quite a loose and easy definition for full employment. But the point is there's so much demand out there that you're actually trying to create jobs a full almost 3% below that. I mean, this is nuts. And then, hence sort of JP's dismissive of, we don't have a wage spiral is ridiculous. Right? We've got Atlanta, which is the better of the metrics, running, we're going to be running at close to 5%, which is where we were in 2000. Right. And the guys on the ground tell you definitively we have a wage spiral going on. I mean, I love listening to what the ISM guys tell you in their various interviews. And the one that just stood out to me from last month actually was from the chairman of ISM Manufacturing. He said, well, people are chasing wages. 27% of my employment comments were related to attrition, and that was the largest component of anything. He said, you hire 2 people on a Monday only to see others leave on a Friday to the factory down the street. It's not clear when this wage spiral stops.
Julian, I want to go back to something you said at the very beginning, which is that there are these periods of essentially real yield depressions that end with pandemics. Well, hang on a second. We've got a whole bunch of listeners who see this inflation coming, just like you and I see this inflation coming, who think that gold is the hedge for that inflation. Now, gold doesn't usually do well when real rates are recovering, and you just said it's a pandemic that tends to mark the bottom of those real rates. So what does that mean for precious metals?
Oh, now you're going to ask me on the market stuff. I hadn't got to that bit yet, Erik. Look, I'm not. I mean, I've been toying around with it. It's technically, and don't get me wrong. I'm not sure that in this world that we live in that we can see a significant rise in real rates. Right? Does the market do it for a while, and the pain that it caused force central banks in? That's my gut. And that's when you really, really want to buy your precious metals. But I'm not sure it's now. This is, I think, that what we have seen over the last, well, certainly since his re-inauguration, is a much more defiant Fed, a Fed that has pivoted extraordinarily hard, right? From, we're going to taper, no rate hikes in 22, to we're going to taper over the next, we'll be done by June. Well, now they'll be done by April, and they're bringing in potentially 100 basis points of rate hikes into 22. I wouldn't be surprised to see from the dots. And so that's not the time that you want to be long, well, probably any risk asset, frankly.
So you think the time for gold is not yet?
Not yet, no. Not and neither silver nor, as I said, not really any risk asset. This is a very, very dangerous time. You've just had a central bank, for all the reasons, who finally the penny has dropped with these guys. They've had that kind of epiphany moment. Oh my God. And this is what I'm literally told. They finally realized that participation rate is not going back up. And if it isn't going back up, Erik, and you already have way too much demand, even assuming it were, then the risks of a sustained overheating of wage spiral getting out of hand is real. Because look at slide 10. This is all happening, boss, in an economy where you've already closed the nominal GDP gap, right? And according to the ISM guys, and the GDP now is even higher than this. We're already growing this coming quarter at 6%. So you're going to put another 6% onto this thing? Like, we didn't manage to close the GDP gap, nominal GDP gap, in a decade. We've done it in 18 months.
And closing a GDP gap during a pandemic, no less.
Yeah. I mean, and the point is, Erik, is, and this is what risk markets the penny hasn't dropped yet. If you've closed your GDP gap, right? Look, inflation's one thing. We can say, and as I said, I mean, there will come a point early next year where you should start to see some of these headline rates start to peter out. But the problem is if you're running an economy too hot, those core rates, those wages, those core CPIs, those rents will keep pushing through. And that's the real enemy, right? Not headline, okay? The real enemy is those core underlying prices, okay? And that's because there will be no spare capacity, okay? So what does that mean? You have to raise rates, not just to tackle inflation, but to actually slow the economy down.
Now, what happens when that raising of rates effectively bankrupts the federal government with increased cost of borrowing?
Well, I mean, that's your third iteration. We're not there yet, right? We haven't even started. I mean, look at slide 11.
Maybe the way I should have asked the question is, how far can that backing up of rates go before it breaks the system?
Well, I mean, I don't know. I mean, it's a difficult, because you could have a situation where nominal rates rise and real don't rise as much, right? Real could be suppressed still, I mean, could we go to yield curve control? Maybe, but that's not now, right? That to me is an outcome that occurs after the next risk-off event, right? What has to happen now is pretty much laid out in slide 11, right? Given everything that I've discussed, that there is too much aggregate demand that is still working through the system, that boa constrictor is still absorbing that last meal, okay? It hasn't manifested itself yet truly in inflation, okay? It hasn't manifested itself yet truly in the labor market, which almost certainly means it hasn't manifested itself in terms of wages, okay? In an environment where we've already closed the output gap in nominal terms, okay? Ask yourself, absent some sort of miraculous event, and almost another nasty wave of COVID would be to some extent helpful, right? And a really nasty one, not what Omicron looks like, because in actual fact the Fed said, and I was surprised by this, I was surprised how hawkish Powell was in the face of this new variant, but it appears that they've come to the conclusion that the longer that the pandemic lasts with this aggregate demand still in the system, the greater the risk that people don't come back to work, right? So the greater the risk that this price inflation becomes embedded, particularly via wages, okay? But ask yourself, everything that I've laid out here, is it right that we have the easiest financial conditions in 38 years? And it's only 38 years because that's as far as the data goes back, right? And ask yourself, what does it mean? Because remember what financial conditions are made up of, right? There's basically 5 metrics in a financial conditions index. 2 rate metrics, short-term rates, let's call them 2 years, long-term rates, let's call them 10. The currency, the dollar in our case, credit spreads, and the equity market. So ask yourself, despite the fact that we've seen quite big moves, which have been very profitable for people like ourselves, right? In the short term and belly of the curve, right? Sort of, DEC 23 euro dollars and this sort of stuff, right? How is it that financial conditions haven't bloody moved yet? And I think that's a significant problem, right? I think that's a really significant problem. And if you don't, and this is what I think the Fed is waking up to, and we've been told this. I mean, one of the things that I always makes me laugh is the honesty of central bankers when they retire, right? And so Bill Dudley, ex-New York Fed president, has gone to work for Bloomberg, and his utterances have been spot on, okay? So for example, there was one in February where he came out and he said, stage 3 of the inflation process will arrive when the economy reaches full employment and inflation has reached its 2% is expected to keep climbing. Okay? All right, well, we've ticked that box. At this point, the Fed will start increasing short-term interest rates. The tightening process will probably have to happen quite briskly, perhaps at a rate of 2 percentage points a year, given that we have a long way to go from near zero to a level that would make monetary policy restrictive. So 200 basis points, let's say starting in April, a year. Well, we're not even close to that in the euro-dollar market, okay? The market actually is assuming that somehow we're only going to go to a terminal rate, roughly, the top of the rate cycle of roughly 175. And it occurs kind of around the end of 23, if you look at the euro-dollar market, okay, of 2023. But he goes on and he's right. So how high will rates need to go? Well, that depends on how easy higher rates will tighten financial conditions and cool off the economy. So in other words, how higher rates will raise the dollar, raise 10-year bond yields, not lower them, raise them because you want to slow the housing market down, okay? Widen credit spreads and slow, if not lower, the equity market, okay? So far, he said, there is little sign they've had much effect. All this suggests that the Fed will have to raise short-term interest rates by considerably more than is currently anticipated. The last time the central bank faced unresponsive markets between 2004 and 2006, it had to increase rates to 5.25% from 1%. This episode may be a better template than the last business cycle.
Bill Dudley said that just on the 3rd of November.
Yeah.
Well, that's a recent quote and certainly timely.
Yeah, and we've shifted from, betting that. I mean, in January and February of this last year, we were selling euro dollars, then we switched to selling short sterling, then we switched to selling Euribor, which is the European equivalent of the euro dollar, mates. These are all 3-month, interest rate futures, and they've worked out very profitably. But I just don't think that we've got it yet. And in a way, Erik, and this is the point, other markets have to respond, right? It's like the old adage: if the tree fell in the woods or the forest and no one hears it, did it fall, right? So I listen to all these equity guys saying, oh, well, we can cope with, 175 on rates. And I'm sitting there and going, but you don't get it. Because you can cope with 175 on rates, 175 can't be the top. Because you have to stop the equity market, going up. You have to drive credit spreads wider. You can't have a scenario where rates only rise to the point that the equity market doesn't care, because that's the tree falling in the woods that no one hears. The Fed doesn't change Fed funds to affect euro dollars in isolation. They do it to tighten broad financial conditions, because nothing hangs off 3-month money, really. Right? They do it to tighten, to raise the price of a mortgage. They do it to slow down asset prices. They do it to make it more expensive for companies to borrow money and do buybacks, right? If you've got to slow the economy down because you've already closed nominal GDP and the demand caused by this massive, historically almost unprecedented stimulus is still damn well feeding through the system, then you may have to go a lot further than people realize. And this just isn't even built into the fixed income markets when you look at, say, slide 13, right? Let's say, the dot plot is right, and I think the dot plot will show 2.5% for 24, right? We've got 5-year yields, nominal yields, at 125, so literally half of that. When you look at break-evens, you've got, essentially what the market is pricing for real yields. This isn't really real yield, but essentially what the market's pricing at close to historic lows. I mean, certainly as where they were just before the taper tantrum, right? Which is why I wonder whether we have that coming to the bond market. I don't know whether it'll be this meeting from the Fed or the January meeting, but I just don't think people realize essentially how rapidly the Fed has moved. To go back to an interview that I did with Grant Williams a couple of months ago, and I just tweeted out something about what are the Czech central banks seeing, because they just raised, I think it's 75 basis points, so the ECB isn't seeing. And the answer is nothing. They just have the ability to move quicker because it doesn't really matter, right? So what did the Bank of Canada see when they literally ended QE? Not just taper, ended the thing that the Fed isn't seeing. The answer is nothing. Just the Fed has to give it a bit more time because they're a much more pivotal central bank, because what they do has much larger implications for assets and risks, et cetera, around the world. And the answer is nothing. They are beginning to see exactly the same thing.
Let's go back to this Bill Dudley quote where he says that they could have to raise rates from 1% to 5.25% in a short period of time. What would break if they did that?
I mean, that was he's talking about the period 2004, 2006. And I think actually that's actually pretty reasonable, right? I think, not the amount, but to draw that analogy, I think there are some pretty strong analogous situation between then and now, in some respects. But just think of it this way, the Trump spending, right? $1 trillion. It took the Fed 225 basis points plus QT to finally crack the equity market, which, by the way, is what you have to do, bare minimum. You have to stop it rising. And we all know once it stops rising, it tends to become quite unstable, okay, to tighten financial conditions, right? And that was on $1 trillion of spending. We've arguably done 6 times that. Right? So who the hell knows what it's going to take to get this equity market to realize that, right? But that's basically what has to break. It has to be the equity market. And, I think we're quite vulnerable. I generally have said this, Erik, you and I have talked many times over, the last 5-6 years. And we've talked about, the Fed creating this crack addict to whom they are now beholden, right? This liquidity junkie that they've created. And, just look at slide 14. This isn't really economics anymore. This is like flow mechanics. Like you put in X amount of liquidity and the other element goes up by Y. Right? In 2013, I did a projection of where the S&P was going to be based off the price action of the S&P for every $100 billion of liquidity in QE2 and the end of QE1. And at the end of QE3, I was 25 points shy. I mean, this is mechanics, boss, right? So if you look at it now and you maybe eke it out until April, maybe 20. What are we looking at? We're looking at 48.50. So another 150 points on the S&P. It's not much. You're kind of running on fumes here. And then things start to get a little dangerous at that point. Right? Typically, the crack addict doesn't like it when you take away his crack. Right? He tends to throw a bit of a wobbler. And particularly if you're going to have to start to price in very rapid rate increases to slow this thing down. Maybe it doesn't crack straight away because the earnings numbers are just too great, and because wage growth is enough that Americans can keep consuming. And I do think America's in kind of the sweet spot where it comes to funding inflation of around 5%, 5 or 6%. I mean, if you look at aggregate weekly payroll, which is kind of like the hours worked times the amount of pay that you earn for every hour, it's rising at 9.5%. So essentially, if you're working, that's what you're earning. So we can fund 4 and 5% inflation. We might not like it, we might bitch and moan about it, but we can do it. And this is the point. I mean, this will eventually, you have to crack the equity market, and you're getting closer when you've turned the tap off. And this is what I put illustrated here with these purple arrows. When the balance sheet goes flat, the risks rise. And what I'm told is that the Fed, if they'd have had the data has changed so much, and now that Powell's reconfirmed, their option was basically to bring forward rate increases or to end QE instantly. They were worried about the market of ending QE instantly, so they pulled it forward as fast as they can, that ending of QE, and that basically means it's done by the end of March.
Moving on to page 15, you've got junk bonds here. Julian, I've been telling myself for like 5 years, surely it's going to be time to short junk bonds any day now, but it seems like that day never comes.
I'm actually short. We shorted them a few weeks ago. We got a technical signal that suggests that, and it hasn't really failed ever. I need another week to totally and utterly confirm it, but it's worked every single time since sort of 2006, 7, and I have a signal to sell, and we're using it as a hedge for shorts that we have on in fixed income. So we're kind of barbelling our risk. We're saying, look, we know, these rates have to reprice, but of course, at any point, if risk assets crack, we know that those fixed income shorts will swing badly against us. So how do we hedge it? And one of the things we've had is this short in HYG, but you could use it for say an equity long, right? It's kind of the same thing, because it's a really clean, as you can see in this, Erik, if and it is my conclusion that financial conditions at 38-year lows, as I said, only 38-year lows because that's as far as the data goes back, are just too easy given this macro backdrop, and they need to tighten. Well, credit needs to widen. HYG needs to fall. So I think it is something you should watch very carefully. It's obviously had a nice bounce over the last few days. It's actually had a perfect technical retracement, 61.8% retracement from the most recent highs. So it's a perfect area, I think, actually to kind of slot this market. And I think it's a great tail risk hedge.
Well, let's talk about those tail risks, though, because it seems to me like the real tail risk is not the the very big tail risk, but the most of the way out on the tail where the market starts to blow up, and then the Fed changes their tune and says, yeah, we didn't really mean that tapering stuff. We're just joshing you guys there. What do you make of this situation, Julian? What's going to happen? Are we really going to taper this time, or is it just another round of the Fed saying what they need to say politically?
Look, I never like to say it's different this time, and it isn't. Ultimately, it won't be, ultimately. But it is a little more nuanced this time. And the reason for that, Erik, this is really the first time that we had a little bit of inflation in 17, right? 16 and 17. But this is really the first time that we've had to deal with high inflation, high wages, high wage growth. And so it is a little bit more difficult for the Fed. I think it just makes the put. I don't think it ultimately takes the put away, but I think you're bloody dreaming if you think the put's at 10%. I know the equity boys at CNBC will just be loaded with the rah merchants in their short skirts and pom-poms going, buy, it's down 10%. I'd sniff if it was down 20.
Now, on page 17, you've got a warning about the 1960s. What's going on here?
So, look, I think the Fed's trapped, and in a way, it's poignant to all central banks. I think, to your point, and as I said, it's never going to be ultimately different. Ultimately, we're going to have to do probably a rinse and repeat. So we get our crisis, we pump more money in, et cetera, et cetera. But they're as I said, they're in a very difficult situation now because, and I think it was hope that they just hoped the inflation would go away, right? Because now what they've got to do is ugly. So they've got to tighten to tackle this overheating economy, but that is going to cause frictions with government. It's almost certainly going to undermine asset prices, and because of hyper financialization. Right, I haven't put the chart in here, but you can go and your guys can pull it up. If you look at JOLTS and you look at it against the broad US equity index, you'll see it's the damn same chart, right? So basically, as soon as the equity market goes down, your jobs growth will just dissipate. So I do truly think, to use a British expression, they're snookered. So it's very difficult. It's impossible for them to kind of hit the ball straight on. They've got to try and play some sort of special shot. It's incredibly difficult. So I think that makes policy reactive. Which is exactly what I think we're seeing now. Right? It's the Czechs saw it, the Canadians saw it, the RBA saw it, the Bank of England saw it. Right? Why haven't the Fed and the ECB seen it? Well, because there's just so much more at stake for these guys. Right? It's not even go down the rabbit warren that the ECB is going to be potentially forced to go down if indeed they have to start to tighten. Right? And what that means to Spain and Italy, et cetera, et cetera. Okay. So they are reactive by definition. And I think that sets us up in this world, and I'm in the process of formulating my thoughts on this. We originally talked about this kind of accelerative oscillation back in early 2017 where Trump comes in. And there is a tendency, Erik, because that's basically how the world works, to assume that everything just reverts to the norm, right? That we kind of work in this world of this sort of nice, benign sine wave. Right. So we get to the top of the cycle and we kind of get, if you think of it in economics, we kind of get an inventory overhang. Right. And so companies start to slow down, because prices have maybe risen enough and people back off buying, and they slow down production. The economy rolls over, and then, they work off the excess inventory, and then we're at the other end of the cycle and prices have dropped and people demand, comes back, and then they start to build it up again. So you get this kind of nice, benign kind of sine wave. And, policy ends up, plays its part, right? It's easing is on the way down. It's pro-cyclical. It's like positive gamma, right? It's easing on the way down and it's tightening on the way up. And it all stays in nice uniformed check, right? And that's what we've had, the great moderation. It's been lovely, okay? And the oscillation of the economic cycles dropped. You go and look at PMIs and you can take them back into the 40s. You can see that the world was just much more volatile, right? Well, there's a reason why you kind of get there. And it's in part because your policy becomes reactive, right? It's you no longer have positive gamma. You're not selling into an up market and buying into a down market. You're, buying in an up market and selling in a down market. And that can get you really screwed up incredibly quickly. And that's kind of what happened in the 60s. So if you think about it and look at this chart on slide 17, so there's three things here. You've got CPI on the top, you've got unemployment, average hourly earnings in the middle, and then you've got government spending. So the world was great, okay, in the early 60s. Halcyon period for assets, both bonds and equities. Super low, super stable inflation, basically oscillating either side of like 1.3%. Back then, we didn't have the debt, so we weren't concerned about disinflation or deflation, right? No central banks were running around waving their hands in the air. Okay, it was just perfect. In fact, the Fed thought when initially Johnson came and started spending all this money post Kennedy's assassination, where he won both houses, right, and he was able to push through this big spending plan, kind of sounds familiar. We can make the comparison to Donald Trump back in 2017 when this happened. Came along and he hit the economy with this unnecessary, right? We didn't need it, but politically driven pro-cyclical stimulus. And far from the cycle just rising up a little bit and then rolling over, it truly kicked it out of phase. Okay. And the reason why we came up with this phraseology of this accelerated oscillation was I was talking to one of my quants who's a mining engineer specialized in explosives. And he said, well, I was looking at this chart, just the top bit, and he said, boy, boss, that's an accelerative oscillation. And I said, what do you mean by that, Stephen? And he said, well, if you think about an explosion happening, right, it just radiates blast waves out. And those blast waves in a void would just go on ad infinitum in some sort of nice, predictable sine wave. So the problem with modeling an explosion is when they hit a wall. Now, if they hit it straight on, the blast wave goes into the wall and is ultimately slowed down at some point, but it's relatively predictable. He said the really nasty stuff is when it hits some obstacle and it glances, because it either can slow it down, the friction can kind of slow it down completely, or rather than that, it can actually accentuate the volatility of the cycle. And that's exactly what happened. So the Fed's sitting there in 64, everything's great. They think they can let unemployment drop. You know, you go back and you can read the minutes. They thought they could drop a little bit further when the fiscal stimulus comes out in 65, and they overestimate it, right? And they start to get wage inflation and inflation, and they start to panic. And they initially raise rates 275 basis points. The end result is a stock market crash. At the same time, actually, you had a housing crisis, unrelated, but they had to deal with a big sell-off in housing. And the effect was a much greater slowdown in the economy than anticipated. They panic, right? Once again, they're reactive, just as they were in 65 to the inflation breaking out. They become reactive. So they're behind their game. They're no longer anticipating, they're reacting, right? So then they panic again. And then they cut rates really dramatically, and they cut them onto the ongoing fiscal spending. And the economy doesn't go back to the lows, Erik, right? It doesn't go back to the lows. It rises again. And wage growth continues to keep pushing higher. And their own work suggests that it only took, this is why I said it's very dangerous for the Fed to be playing with these inflation expectations and dismiss them, because we're already 18 months we've had rising inflation expectations, and the Fed's own work suggested in the late 60s it may have only taken 2 years for those inflation expectations to become unhinged. Okay, and then they really hit it hard, or they think they really do, and the stock market drops 36% this time, and then they panic again. And the point is this reactive policy response. Right? Remember, we've got more fiscal coming in 23, 24. That's when all the infrastructure will get spent, right? So it may slow from the absolute peak now, but it still will be ongoing. I think could set us up for something that looks like the 60s in terms of inflation. So we won't go back to the lows. As I said, I think all other things being equal post-COVID, it probably would, absent COVID, we probably would have seen the lows in 16, right? There were all sorts of reasons to think that societally we needed to move into a higher fiscal spending environment, right? COVID's just accelerated that inevitable tipping point, right? It's just like the ends of those real rate depressions we saw over the last, many hundreds of years, where you ended those real rate depressions because of the end of a pandemic or geopolitical thing, which this time could easily be the US-China, right? And the breaking down of those supply chains, et cetera, right? But the point is Once policy becomes reactive, okay, there is a risk, Erik, that because it's late, rather than naturally slowing, rather than just dampening down those nice sine waves, right, that it hits it at the wrong point and it accentuates the cycle. And that's how things get out of whack, right? And if you, at the same time, if you're moving to a just in case from a just in time supply chain where you build up much bigger inventories. I mean, I'm not dismissing the fact that we could have a recession in the second half of next year. I can easily construct a scenario where that happens, okay? That we've actually built up too much inventory, right? And the Fed starts to hike really aggressively in the first half of next year. They've run down that balance sheet, right? Suddenly all those chips arrive, all that manufactured inventory, and there's a lot of semi-finished manufacturing inventory sitting out there, ends up on dealers' forecourts or onto shelves of stores, right? We go from famine in terms of supply to feast in terms of what's in front of actual consumers, just as the Fed's, reaching, cruising speed in terms of tightening, that we could crash down again. But that's back to that very volatile kind of world that we were, because the big thing that used to throw us off whack in the past were those inventory cycles, right? And then you get into all these sorts of games, right? What does the Fed do then if we get another crisis, right? What does the Fed do then, Erik? Right? Well, I think we know the answer, boss. So look, I think at some point they will do what they've always done. They will subsidize the bond market and they will support the equity market. And I think it's exactly what happened in the 60s. The dollar will ultimately get thrown under the bus. We're not there yet. We've got to get the crisis to get the response function to deliver that. Okay. But if they go down the road of they decide that suddenly, real rates shouldn't be higher and that they need to come in and do either accelerative QE or YCC or something like that, I can easily see the dollar getting thrown under the bus. I don't have the position on now. You can see on the last chart, the dollar's nowhere as far as I'm concerned, okay, at this point in time. But I think it's getting very interesting. I think people are grossly underestimating, and certainly the equity market is grossly underestimating the risk presented by the central banks at this point. Because I think finally the Fed is beginning to see what we've been talking about for a year now.
Well, Julian, I can't thank you enough for a terrific interview. Before I let you go, though, please tell us a little more about what you do at MI2 Partners.
So MI2 Partners is we've been around for over 10 years now. We're an institutional research provider, and most of our clients are sort of hedge funds, big mutual funds, family offices, et cetera, et cetera. And if you're interested in getting in touch with us, you can get in touch with us at support@mi2partners.com. If you are retail and you'd like to follow us, then you can also use that same address, support@mi2partners.com, and we'll put you in touch with the guys at Real Vision. So Raoul, Powell, and myself have a joint product called Macro Insiders, and it's more geared towards that type of investor. And then finally, if you just want to follow me, then follow me on Twitter at Julian MI2.
Patrick Ceresna and I will be back as MacroVoices continues right after this message from our sponsor. Escrow.com is the payment system for buying and selling anything of value: cars, boats, airplanes, jewelry, gemstones, fine art, collectibles, intellectual property rights, domain names, bringing in shipping containers from overseas, or even buying and selling entire businesses. It's simple to use. Either party sets up the transaction, then the buyer sends the funds to Escrow.com. The seller is then instructed to send the goods to the buyer to inspect. Within the inspection period, the buyer can return the items for any reason. After that, Escrow.com pays the seller immediately. Escrow.com is the world's most secure payment system from a counterparty risk perspective because the funds sit in escrow. Over 2 million customers have transacted over $5 billion on Escrow.com, and eBay and Shopify use it for cars, boats, luxury watches, and business sales. It's available in the United States, Canada, and Australian dollars, euros, and British pounds. Never buy or sell anything online unless you use Escrow.com. Escrow.com is a subsidiary of Freelancer.com, listed on the OTCQX Best Markets under the ticker symbol FLNCF. and the Australian Securities Exchange under the ticker FLN.
Now, back to your hosts, Erik Townsend and Patrick Ceresna.
Erik, it was great to have Julian back. I was looking for somebody to make a legitimate stance on the bearish side of the market, and it's really interesting that Julian made a pretty good case for that. Now, I'm not necessarily seeing all that in the short-term technicals, but it really is a compelling macro case as to why the equity markets might have some risk ahead of them for the 2022 year.
Patrick, I couldn't agree more. You know, what Julian's comments really made me think is, okay, look, I'm convinced that the Fed will bail out the markets again. There's no doubt in my mind. But really, with how firmly they pivoted into a very hawkish stance, they really can't change their stance again until the market gives them a reason to. And I think the market probably will give them a reason to. So it's going to be very interesting to see what happens. In any event, that's a perfect segue to our post-game chart deck, which this week is titled Correction or Crash, Part 2. What do we have here on the second page but an S&P futures continuous chart? What's going on?
Right. So last week we talked about how horrible the market breadth was and how the S&P 500 wasn't really reflecting accurately quite how deep and how significant of a correction that we already saw. So here on the S&P chart, we're just I have that 50-day moving average, and also highlighted in the green box the 50% retracement as well as where the previous highs were. And based on just purely textbook technical analysis, the market simply retraced down to its average price. All previous highs acted as support. The correction lasted a typical several week mean reversion correction and is already attempting to bull breakout all over again. And so far, you have to give it to the correction camp, and that this really does look like it has turned back up. Now, we're coming to a pretty critical moment, because always as you approach a previous high, there's famous patterns like double tops or fake out breakouts like to create a head and shoulders pattern type of thing that could always occur. But right now, the pattern of dips being bought and new highs being made remain intact. And while Julian made a pretty good case that why the equity markets could run into some risk, at least at this moment, I don't see much technical reasons to believe that that's the case. And so right now, I think over the very short term, I'm willing to give the bulls the benefit of the doubt that they're going to be able to bust this towards 48, 4,900 on the upside. But Julian makes a good enough case that I'm going to be paying attention and looking for that canary in the coal mine that something isn't working out that way.
Well, let's take a look at the VIX on page 3, because, boy, it was through the roof, and it seems like it's most of the way through a full retracement.
Right. And so whenever we get those kind of Charlie McElligot's quants on talking about option positioning, one of the things that is always observed is that when you have huge spikes in volatility, that once that volatility starts to normalize, it creates a tailwind behind the markets known as VANA, which is as volatility is contracting, it actually reduces the amount of short positioning dealers have to have, and it actually pushes the market higher. So arguably, the first impulses higher on the market were given this tailwind. Now it's really going to be a question as to whether the bulls can build on this initial slingshot higher, and whether the market itself breaks to a higher high. Like when we look at page 4, where I have that percentage of stocks above their 50-day moving average on the New York Stock Exchange, you can see that we were at the lowest level since the COVID crash on this metric in just a 2-week S&P correction that was just a mere couple hundred S&P points. It's amazing how the breadth of the market deteriorated so significantly, but it was oversold enough that typically marks a tradable bottom. And so this to me supports the idea that markets may still have a bit of a Santa Claus rally to go over the next couple of weeks that may even push the market to higher highs. While I do again see potential risks in the new year for the equity markets, at least on the short term, it looks like the bulls have the control of this market on the short term.
Let's move on to my favorite chart on page 5, crude oil futures.
Right. And well, first of all, that was such a devastating drop in late November that basically did some significant technical damage. But at least on this January contract, you can see how we traded right back down to the summer lows of crude oil. I mean, it just barely printed as low as the August low, which was all the way down at 61. But there was inevitable that the market was going to get a reflexive rally, which is when something is so oversold. It's just reflexive to be able to mean revert or retrace some of the drop. But here we are at about a 50% retracement of the entire drop. Yeah, we rallied about $10 from the intraday low to where we are today. And this is actually the real kind of make it or break it level in my mind, Erik, because if this was just a reflexive snap and that still double bottoms or more consolidations in store, this is exactly the level where we could go back to $68 or $65 and go back and retest some of those places we were just trading a week ago to establish a tradable low. Really important moment here in crude oil. What's your take on it?
Patrick, I will defer to your wisdom as the technician and short-term trader. My view fundamentally is this whole thing was about a panic over Omicron might be the strain that shuts the global economy down to the point where there's global lockdowns and air travel ceases again, and we go to negative oil prices. That's what brought this all on, and we've seen the equity market retrace pretty much completely. The crude oil market's only retraced half of the drop, and I don't see any evidence to tell me so far that Omicron is a really big deal. It seems like it's a very big deal in the sense of its transmissibility. Almost everybody is going to get it. But it sounds to me like this one really is what the media was trying to tell us was happening at the beginning of the real pandemic, when they said, look, it's just going to be a bad flu and there's nothing more to it than that. It sounds to me like Omicron really is the one that's going to be just a bad flu and something that maybe almost everybody's going to get, might even help with herd immunity. Once we figure all of that out, I think that the fundamentals are definitely in place to get us above $85 by next summer, probably sooner than that. And I think it's possible that we could get well over 100 by next summer. Now, as far as whether or not we go back down and test, I don't think we go back to a new low below $62. Do we go back down to 65? I don't know. Probably only take a headline or two to get us down there. And I wouldn't expect it to last long. Let's move on to gold futures on page 6. Patrick, tell me about this consolidation. I mean, it's been quite a while.
Absolutely. And so first of all, we're usually looking at daily charts. This is a weekly chart. So we're trying to grasp 3+ years of data on here, showing including the huge 2019 to 2020 run in gold that took it from like 1,200 to 2,100 on the upside. We've been obviously in a very deep consolidation. And just like we were talking in the market wrap at the beginning, there was a breakout. And there was a breakout that happened. It was the same level that you and Ole Hansen were talking about, some of those key consolidation highs that was advertising a potential beginning of a next bull leg in gold. That got very quickly derailed. And this entire pullback on gold over the last 3 weeks did enough technical damage to say with at least a reasonable high degree that it was a false start on the upside. But just because it was a false start on the upside doesn't necessarily make it bearish. It simply is much more likely that gold is going to stay in this purgatory trade range. Vulnerability down to the low 1700s is now entirely possible. But I think that the bigger picture stance we have on gold remains somewhat intact, so long as the trade range is contained and the gold prices stay winding up for ultimately the catalyst for it to go higher. Maybe it just is going to be a second quarter 2022 story, and gold is just going to stay in this trade range for throughout the remainder of the year and to start next year. But I don't think I want to tilt bearishly yet. It's certainly just gold has failed to start bulling higher.
Let's move on to the Chinese A50 stock index on page 7.
Right. And so I'm curious if that Evergrande default finally was like the sentiment shift that was needed to tilt the market. What's interesting about the China A50 was that it's truly been the global equity market that has kind of marched to the beat of its own drum. The rest of the global equities have more or less been correlated to some degree or another. And while China remained in somewhat of a bear market decline for the better part of the entire year. And what we really have seen throughout the latter part of the summer, mostly in the third quarter and into this fourth quarter, was the Chinese market was really basing. And even all of these negative headlines that have been coming out was simply weren't hurting their equity market anymore. And this pattern really starts to look like a very traditional technical one called the cup and handle formation at the bottom. And we're really seeing now that the China A50 is trying to break out. And a couple days doesn't make a new trend, but this is how they often begin. And it's really interesting to see whether or not this is the turning point in China.
What's happening to Bitcoin on page 8, Patrick?
Well, it's interesting. I was arguing about how Bitcoin was actually behaving pretty well right up into the middle of November, and how generally it was holding fib zones and could bullishly break out. But really, the last week when Bitcoin broke down below 55,000 with a legit breakdown, that was serious technical damage that changed the technical profile of Bitcoin. And the fact that it kind of crashed to the downside, almost like crude oil did in some degree or another, and just like a rapid liquidity event that wiped out 10,000 plus points in a span of 24 hours. But the snapback and reflexive rally did happen, just the way it happened on other markets like crude oil. But it really so far looks pretty weak, and it looks like it's rolling over. And really, while I don't want to make an outright bear call out here, I would say this, that the bulls really need to get this Bitcoin north of 55,000 on the short term to neutralize the sell cycle. Every day Bitcoin stays below that level, the more likely it is that there's another leg coming to the downside, and maybe something under 40,000 that we'll have to take in order to establish a new tradable low. But this chart has really shifted in the last week, and all the bull cases can now be at least temporarily taken off the table.
Listeners, if you enjoy Patrick's chart decks, you can get them every single day with a free trial of Big Picture Trading. Information is on page 9 of the slide deck or at bigpicturetrading.com. We're going to leave it there for this week's show. This episode is brought to you by Abex Technologies, pioneering the design of smarter markets that better serve the needs of both market participants and society as a whole. And by escrow.com, the world's most secure online payment system from a counterparty risk perspective, because the funds sit in escrow. Patrick, tell them what's in this week's Research Roundup.
Well, this week you're going to find the transcript for today's interview, as well as a link to Julian's slide deck and the chart book that we just discussed here in the postgame. There's also a link to an institutional investor article that Cathie Wood was last year's hottest investor, but is there a lesson for her fans in a forgotten 1990s icon? There's also an article from Jesse Felder, When the Smart Money Says Sold to You. You'll find this and so much more in this week's Research Roundup. That does it for this week's episode. We appreciate all the feedback and support we get from our listeners, and we're always looking for suggestions on how we can make the program even better. For those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com, and we will consider it for our weekly distributions. If you have not already, follow our main Twitter account at MacroVoices for all the most recent updates and releases. You can also follow Erik on Twitter at Erik S. Townsend. That's Erik spelled with a K, and myself at Patrick Ceresna. On behalf of Erik Townsend and myself, thank you for listening, and we'll see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at macrovoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Erik Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.